Title page. Prologue.
This prologue shall provide an idea about the philosophy underlying the Johnson-Omega method. It is a commonplace that portfolio construction is the ultimate challenge in finance, as it requires forecasting and a rigorous, intuitive, transparent and non-discretionary processing of the estimates. Apart from the risk-free return spot forecasts are impossible. It is possible, however, to estimate probability distributions based on stylized economic facts reflecting trends, cycles, herding, current and asset-specific volatilities and the asset class-specific likelihood, direction and magnitude of extreme events. Further, experienced co-movements such as correlation should be accounted for. Most importantly, however, is to account for the correlation to one phenomenon in case of crashes by using only weakly diluted higher co-moments, up to an order, which is economically meaningful and possess significance. Historical prices contain all that information and it is up to a sophisticated optimization procedure to quantify the experiences and to derive an optimal portfolio. To put it differently, it is pointless to attempt predicting a crash for next day, but one can estimate the likelihood of a crash happening, say once in 8 years, based on past experience. A portfolio should generate significant jets in alpha and excess, absolute and risk-adjusted returns over entire business cycles undergoing sunshine, thunder and lightning. A portfolio needs to balance the two extremes. On the one hand, to keep upside potential, a portfolio should not be constructed permanently in anticipation of a crash happening in the next instant. On the other hand, to avoid devastation in rare events, a portfolio should not be constructed in the naive belief financial tsunamis will never happen again just because of normal markets in the past few years. The Johnson-Omega method was developed having the metaphor from the famous mathematician Benoit Mandelbrot in mind: build a portfolio as a ship, constructed to survive a storm and not in the blue-eyed and wishful thinking of sunny weather across the ocean. The workhorse to model, measure uncertainty and to attribute appropriate likelihoods to all possible outcomes is the Johnson distribution. The omega measure applied to the Johnson distribution is called Johnson-Omega and links portfolio theory to option pricing. The put-call parity tells us that the payoff from being invested in a portfolio is equivalent to being long a call and short a put on that portfolio. The omega measure is simply the ratio of call over put and therefore the natural measure, to be optimized with respect to portfolio weights. This clip intuitively explains how Johnson-Omega works. It elaborates about its advantages over empirical omega and traditional performance measures, and shows transparently why it is able to generate superior portfolios. As a practical example, the Lehman collapse, besides LTCM or Russia crisis in 1998, the worst month in hedge fund industry since January 1990, is taken under investigation. Please note that non-investable HFRI indices were chosen, as their characteristics are best understood by market professionals helping to understand the nitty-gritty of what follows. It can be seen that findings capture and quantify qualitative experiences from the past, which were characteristic, stable and significant for decades. As Lehman collapse is just a snapshot, backtests over entire business cycles for investable, traditional and alternative assets were made and are available upon request. Here it can be verified that Johnson-Omega persistently outperformed the benchmarks with respect to absolute and risk-adjusted returns rigorous, non-discretionarily, without any possibility for data mining.
Introduction and table of contents.
Let us start with a review. 10 years ago, Johnson-Omega was applied to HFRI hedge fund strategy indices. The results showing that Johnson-Omega portfolios performed superior during LTCM or Russia crisis to Sharpe was published in the cutting-edge section of the Risk magazine in April 2005. It could be seen that Johnson-Omega outperformed, as it was able to account for asset-specific characteristics central and co-moments, which were already significant, before LTCM Russia crisis in 1998. In August 2008, the article was republished within the Risk Book series under the title Portfolio Management Groundbreaking Technical Papers by Berkshire. The present clip considering Lehman crisis and fall 2008 affirms the findings from the LTCM collapse. The clip transparently shows how and why superior portfolios prior to Lehman collapse could be constructed by taking asset-specific information into account, which is not captured in the traditional mean variance space. The clip is organized as follows. First, the universe and moments estimates are explained and determined. In the second section, the Johnson distribution will be introduced as the workhorse to model uncertainty. A justification that Johnson distributions are appropriate is delivered in section 3. In section 4, the Johnson omega, which is an application of Chadwick and Keating's omega to Johnson distributions, is introduced. In section 5, it is shown that Johnson omega links and extends the Nobel Prize awarded theories by Markowitz and Black-Scholes-Merton. In the sixth section, it is shown that the optimization process is intuitively following from expected marginal attribution, which shows how bending and shifting the distribution through weight changes improves portfolio characteristics. The Johnson omega portfolio optimization process is visualized in a slideshow in section 7. The realized performance in comparison to major benchmarks is given in section 8. In section 9, it can be seen that the Johnson omega optimized portfolio might be superior to a Sharpe portfolio for each rational investor, irrespective whether risk-averse, neutral or risk-lover. Finally, section 10 gives a summary about Johnson omega features and a conclusion.
Estimation page.
Monthly HFRI index data since January 1990 are used, as best understood by professionals helping to understand the nitty-gritty of what follows. Simplest estimates and free constraints in the framework of a 130/30 portfolio were applied for the sake of transparency and data mining avoidance, although even stronger results might be achieved with sophisticated factor, ARIMA or GARCH-type models or optimizing bounds. The 6 months averages prior to Lehman were already negative, indicating the presence of a downtrend. Volatility is based on past 12-month standard deviation to better account for current volatility environment. Skewness captures the direction and kurtosis the magnitude of extreme return experiences and naturally estimated on entire available history. The findings from pre-LTCM investigations are affirmed. Low volatility strategies, event-driven and relative value, have substantial fat tails towards the downside in contrast to macro with its favorable tail properties. Also, equity hedge has fat tails, but rather neutral with respect to direction. Extremely risky in any respect is emerging markets. The co-moments, that is correlation, co-skewness and co-kurtosis, are estimated on an accruing window, to capture extreme past events asset interactions. This important information is quickly diluted within correlation, but remains memorized, visible, stable and significant in third and fourth order moments for decades. The Johnson omega framework solves for the ambivalence or amplification between volatility, tail direction and fatness by comprehensively and non-discretionarily utilizing central and co-moments up to fourth order. The fact that noisy higher moments are endogenously determined, justified by chi-squared tests and not able to distort optimization enables the Johnson omega method to provide a diversification, which holds when needed. That is, in crashes. Details with respect to co-moments become transparent through expected marginal attributions analysis in an extended clip.
Johnson distribution.
The skew-kurtosis chart shows that all strategies deviate substantially from normal and log-normal distributions. In the distribution chart, it seems that macro is quite risky. However, what happens in the tails becomes visible when using a logarithmic scale. Macro declines by magnitudes quicker in the downside tail despite of higher volatility. This phenomenon is captured in the Johnson omega framework by skewness and excess kurtosis. Chi-squared test confirm appropriateness of Johnson distributions for all strategies, therefore extended clip.
Justification of Johnson distributions.
The chi-squared test to check appropriateness of the Johnson distribution, that is affirmation that endogenous determined moments of order 5 and higher fit to data. Test successful. All Johnson errors below critical levels. Close match between theoretical and realized number of occurrences. All Gauss errors clearly exceed critical levels. Poor fit. Even worse, Gauss fit poor not only in tails, but even in the center. Hypothesis that Johnson distribution correct cannot be rejected, even at low confidence levels.
Fourth section. Johnson omega.
The logic of Johnson omega is explained on this page. 1a covers the 7 constituent central and co-moments of and between the 5 constituting hedge fund strategies. Those were estimated such that stylized economic facts are reflected. Moments are fixed throughout the optimization. 1b shows the portfolio weights of the initial weights, which will be subject to the optimization. 2 represents the 4 portfolio moments, which are uniquely determined by constituents central and co-moments 1a and portfolio weights 1b. It can be seen that the equally weighted portfolio has a negative expected return, a substantial volatility, a severely negative skewness and a large excess kurtosis. The benchmark portfolio is therefore quite risky as it has high volatility, as will be shown shortly, amplified by a fat tail to the downside. In 3 the Johnson distribution, which is uniquely determined by the portfolio moments, is shown. In step 3' the Johnson omega concept is imposed. Therefore the mean of the equally weighted benchmark portfolio is introduced as natural hurdle. Returns above the benchmark mean are appreciated, below are disliked. Please note that e.g. life insurances or pension schemes, who are forced to deliver guaranteed returns, may adopt the hurdle accordingly. The red shaded area equals the Johnson put price subject to a simple discount factor, where strike equals hurdle. The blue shaded area is the price of the Johnson call, again, subject to the simple discount factor. Both prices are equal by definition of the mean and amount to 0.73%. The Johnson put price might be interpreted as the price for an insurance against returns below the hurdle of -0.79%, that is the expected mean of the equally weighted portfolio. Further, the put-call parity tells us that an investment in the equally weighted HFRI strategy portfolio might be interpreted as being long a Johnson call, and short a Johnson put of the price of 0.73% of the amount exposed to the equally weighted HFRI portfolio. It follows that the initial Johnson omega ratio, that is Johnson call over Johnson put equals 1. From the Johnson cumulative density the minimum expected returns at given confidence levels might be drawn. It can be seen that there is substantial risk to the downside. E.g. there is a 5% chance that monthly returns fall below -4.1%. Furthermore, the upside is comparatively poor, there is a 5% chance that returns are higher than just 2.1%. In summary, the slide shows how weights influence portfolio moments, which determine Johnson distribution and thus Johnson call and Johnson put and eventually the Johnson omega. The optimization procedure will then be with respect to those constituent weights.
Fifth section. Markowitz, Sharpe and Black-Scholes-Merton.
In this section it is shown how smoothly the Johnson omega method fits to well-established theories. To simplify the illustration, the long-only portfolio is considered. Further, in order to keep the Markowitz and Sharpe applicable, at least one asset with a return above the risk-free rate is needed. This precondition was violated prior to Lehman collapse. To overcome this issue, moments are estimated based on entire available history. This gives further interesting insights over the long-run risk-return relationship in different spaces. It can be seen immediately that the Sharpe optimal portfolio is almost equal to event-driven. A slightly lower volatility, a slightly higher mean, but a substantial fat tail to the downside, as can be inferred by skewness and kurtosis. The location of the Sharpe optimal portfolio affirms prior findings, that is that Sharpe optimized portfolios are biased towards low volatility. In contrast, the Johnson Omega optimized portfolio has lower Sharpe, which is however much more realistic over the past 25 years. Furthermore, the tail properties are substantially improved. Lower asymmetry to downside and massively reduced tail fatness. Overall upside, that is Johnson call, is clearly higher than downside, that is Johnson put. The example shows that Omega simply generalizes the Markowitz efficient frontier and Sharpe to the Johnson call Johnson put space, where skewness and kurtosis are taken into account. It is important to note that the level of leverage can also naturally be included in a Johnson Omega optimization, as the risk-free asset may be included as a portfolio constituent. Johnson Omega concept does not break down, in contrast to Sharpe, when all expected returns of risky assets are below the risk-free rate.
Sixth section. Expected marginal attribution.
In order to get a feeling and understanding for the impact of increasing the exposure to a specific strategy, an expected marginal attribution abbreviation, EMA analysis is provided. The Johnson Omega methodology becomes transparent as it is shown how a change in exposure affects portfolio moments, that is mean, volatility, skewness and kurtosis. Furthermore, Johnson call, Johnson put and eventually Johnson Omega EMA gives a better understanding for the impact of central and co-moments of third and fourth order, and shows the important diversification benefit in the tails. Eventually it can be seen what impact a change of weight has to the Johnson Omega, which is simply the ratio of Johnson call over Johnson put, that is the measure to be optimized. It becomes transparent why the allocation to a specific asset should be increased or reduced. Let us take an example. If 1% weight is added to macro relative to the equally weighted benchmark portfolio, then this increases portfolio skewness by 1% times 1.77, that is 0.017. Thus the distribution of the portfolio is bended from negative in the direction to positive skewness. Further, the kurtosis, that is tail fatness, is massively reduced. As a result, outliers towards the downside become less likely through this improvement with respect to fat tail properties. On top of this, adding to macro reduces volatility, and has a positive impact on the expected mean. The four improved moments then have a positive impact on the Johnson call and Johnson put prices. The former increases its value by 0.22% times 1%. Which equals 0.0022% or 0.22 basis points. The latter is reduced by minus 0.21 basis points. Overall, adding 1% to macro increases the Johnson Omega ratio by 1% times 0.85, that is 0.0085. Thus, the expected marginal attribution shows where an optimizer will allocate preferably and why. EMA provides a breakdown with respect to the portfolio moments depending on the portfolio weights. Subsequently, the expected marginal attribution analysis for the individual HFRI strategies is discussed. 1. HFRI event-driven provides a positive attribution to returns, however, joined with an increase of volatility. A poor impact on the tail properties by increasing exposure is due to the decrease of skewness and the increase of kurtosis. The distribution is basically bended toward a fatter negative tail. Overall, the upside, that is Johnson call, is increasing. Downside put becomes reduced, as the worsening of risk is compensated by the increase of the expected mean. 2. HFRI equity hedge. Mean decreases and volatility increases. This negative impact is not compensated by improved tail properties. Therefore, a negative attribution to Johnson Omega. 3. HFRI emerging markets, clearly negative impact on mean together with only a slight increase of volatility despite of a high volatility as a standalone. However, strong negative attribution to skewness and positive to kurtosis. Thus adding to the strategy is bending the distribution towards an enormous fat tail to the downside. 4. HFRI macro. The positive impact of the strategy was already addressed in detail. 5. HFRI relative value. This strategy attributes both to mean and reduces volatility. It therefore is excellent, if considered solely in the main variance framework. However, relative value has a negative impact on skewness and causes an increase of excess kurtosis. Again, the low volatility strategy bends the distribution towards a fat tail to the downside. It is important to note, in the traditional sense this index has a very positive impact on diversification. Taking into account skewness and kurtosis, the picture is contrary to macro. This is an indication that diversification breaks down when needed. In contrast, macro is likely to be more robust in case of stress events. Overall, the upside potential is increased, and downside risk is reduced due to the very positive impact on expected mean. This results in a positive attribution to Johnson Omega.
Johnson Omega optimization.
The initial, equally weighted portfolio remains visible as shaded, while portfolio subject to optimization is represented by filled bars. It is crucial that Moment estimates 1A capturing only economically meaningful and significant economic stylized facts and nothing more, that is, excludes implicit and explicit noise and insignificant information. Together with portfolio weights 1B, the portfolio moments 2 are uniquely determined. Those in turn uniquely determine the Johnson distribution 3, that is the dashed line. The cumulative density provides the minimum expected returns at each probability level. E.g., there is a 5% chance that returns of equally weighted portfolio in subsequent month September will fall below -4.1%. A hurdle which equals the mean is introduced. The hurdle separates the blue area from the red area. The blue area measures the upside potential, and is calculated as Johnson call. The red area measures the downside risk, and is calculated as Johnson put. The put price can be interpreted as the price of an insurance against returns below the mean. The call over put ratio is called Johnson Omega, which is initially equal to 1 by definition of the mean. Please observe weights, moments, options, omega, as well as minimum expected returns, during the optimization, which will start now.
Johnson Omega optimization result.
The optimization result is as follows. Mean increased. Volatility is reduced. Thus, the portfolio improved already in the main variance, Markowitz, Sharpe and traditional sense. Moreover, the distribution is bended from negative skewness towards positive. Further, excess kurtosis is almost completely eliminated. As a result, the dangerous fat tail vanished, before Lehman collapse. Thus, the Johnson Omega shifts and bends portfolio distribution, which becomes better in the traditional mean variance sense and furthermore has superior tail properties. Downside risk, that is Johnson put, is massively reduced, while upside potential, that is Johnson call, is increased substantially, implying an increased Johnson Omega. In particular, tail risk becomes much lower, body only slightly weaker upside tail. E.g., after Johnson Omega optimization there is a likelihood of 5% that returns of the Johnson Omega optimized portfolio fall below -1.6%, which is a substantial improvement. Density is almost first-order stochastic dominating, that is preferable by each rational investor irrespective whether risk-lover, risk-averse, and as utility function.
Optimization minimum variance.
The minimum variance portfolio is added in orange. expected mean is poor, due to ignorance of downtrend. Its volatility is slightly lower, but a substantial fat downside tail due to negative skewness and high excess kurtosis. Higher downside risk despite of lower volatility, which in turn destroys upside potential. Ignorance of the trend, which is one of the most stable and best understood stylized fact in Financial Times series, and ignorance of skewness and kurtosis leads to inferior portfolio.
Optimization maximum return.
The maximum return portfolio, added in yellow and incidentally equal to the optimal Sharpe, has highest expected return. It has also highest risk due to a high volatility, which is even amplified by a fat tail, due to slight negative skewness, combined with significant and substantial excess kurtosis. Downside risk increased stronger than upside potential, leading to inferior Johnson Omega. Highly risky, in particular fat tail risk to downside.
Optimization summary.
Aggregates ex ante Lehman collapse expected performance. The table summarizes the moments, showing the superiority of the Johnson Omega optimized portfolio in contrast to its peers. The moments uniquely determine the Johnson distributions. More illuminating, in particular what happens in tails, is shown by the logarithmic chart. Johnson Omega achieves an improvement with respect to capital protection by magnitudes, as can be seen in the quick decline of the blue curve for negative returns. Overall, the Johnson Omega portfolio has a clearly better expected upside over downside relationship in tails. Economic reasoning is that the superior Johnson Omega achieved through fully exploiting long macro and short emerging market potential, by squeezing juice out of data completely and the capacity to process information rigorously. All other portfolios have dangerous fat tails, in all cases with at least a tendency towards the downside.
Realized returns.
Expectation is one thing. Realized returns during Lehman collapse another. As an LTCM crisis, the low volatility strategies event-driven and relative value suffered more than 3 standard deviation drawdowns during Lehman collapse September 2008. Macro was again stabilizing, due to its favorable distribution properties and interaction with other assets in the portfolio. Gauss theoretical frequencies deviate substantial from realized. Johnson theoretical frequencies fit quite well to realized. Johnson Omega portfolio performed best. More than one LTCM-like event was already expected prior to Lehman collapse. Obviously, Johnson Omega accounted well for rare event, asset characteristics standalone and co-movements during market dislocations. All other portfolios' volatilities did not attribute appropriate likelihoods to Lehman-like collapses, and suffered worse than 3.2 standard deviation events. The minimum variance portfolio experienced a second time an event, which was expected to happen just once in 90,000 years. Johnson Omega outperformed all benchmarks and controlled for the high-risk low-volatility strategies, by sorting the wheat from the chaff of the data, and rigorously and non-discretionarily processing economic meaningful, significant and asset characteristic asymmetry and tail fatness at arbitrary levels. Lehman collapse is just a snapshot. Backtests over entire period, that is more than 2 decades, showing that all benchmarks are persistently and significantly outperformed by Johnson Omega, are available upon request.
Ninth section. First-order stochastic dominance.
Here is an excursion to portfolios, which are optimal independently of investors' risk preferences and utility functions. Many investors rank portfolios with respect to their Sharpe ratio. In the following example, based on real annualized returns characteristics between January 1990 and October 2014, it is shown that this might be misleading. two portfolios are compared. Firstly, the Sharpe Optimal portfolio is purely comprised of low volatility strategies, event-driven and relative value. Not surprisingly, the portfolio has a significant and substantial negative skewness and a significant and large excess kurtosis. This is a big fat tail to the downside, which is not recognized in the main variance space. Low volatility is bought by comparatively low expected return. Secondly, the Johnson Omega Optimal portfolio has a lower allocation to the low volatility strategies. Instead, there are allocations to macro and equity hedge, due to their favorable impact on portfolio tail properties. Furthermore, volatility is not per se discriminated. In contrary, it may even add value, as it increases the upside potential, that is the value of the Johnson call option. This value is also amplified by a higher expected mean. It is now the question, which portfolio should be preferred by a rational investor? Is it the Sharpe Optimal portfolio or the Johnson Omega Optimal portfolio? The answer can be found when looking at minimum expected returns. It can be seen that the Johnson Omega portfolio first order stochastically dominates the Sharpe Optimal portfolio. This means that at each level of confidence the minimum expected return for the Johnson Omega portfolio is higher than the minimum expected return of the Sharpe Optimal portfolio. For example, it can be seen that there is 1% chance that the Johnson Omega returns fall below -9.8%. The Sharpe portfolio is riskier, as it has a 1% chance that returns falls below -11.7%. Furthermore, it has a better upside potential, e.g. there is a 5% chance that returns of Johnson Omega portfolio exceed 17.6% in contrast to only 15.1% for the Sharpe Optimal portfolio. No matter which confidence level is chosen, the Johnson Omega portfolio has better upside potential and simultaneously a better downside protection. Thus it first order stochastically dominates the Sharpe portfolio, and is therefore the preferred portfolio by each rational investor, irrespective of his utility function or risk preferences, no matter whether he is risk-averse, risk-neutral or risk-lover.
Summary and conclusion.
Johnson Omega accounts for economically stylized facts related to mean, covariance, skewness and kurtosis of and between assets. Able to account for each combination of asymmetry and tail fatness. Provides superior diversification, which holds when needed, by accounting for only weakly diluted central and skewness and kurtosis. Ignores and does not require other noisy estimates and calibrations. Avoids data mining as non-discretionary, as first four moments are uniquely and comprehensively mapped by Johnson-based formulas. Extends the theory of Markowitz modern portfolio theory, to call put space accounting for skewness and kurtosis. Employs proprietary call and put prices in Greeks, which generalize Black-Scholes-Merton to arbitrary asymmetry and tail fatness. Links intuitive and naturally both theories through put-call parity. Reduced model risk as Johnson Omega directly utilizes cumulative density. Idea is to shift and bend density to higher risk-adjusted expected returns. Consistent with traditional performance ratios. Allows higher upside potential, as volatility not discriminated per se. Risk, that is Johnson put his cost of insurance below hurdle. Generates potentially first-order stochastic dominating portfolios, which are preferable by each rational investor, irrespective of his utility function. Allows to naturally include risk-free asset and optimization for an endogenous, non-discretionary determination of leverage. Naturally given hurdle, induced by benchmark portfolio, may be modified for e.g. pension funds, which must generate guaranteed returns. Allows to be applied to all kind of portfolios, e.g. long bias. Allows to optimize fast and unique due to availability of closed-form solution of performance measure. Tested practically on various universes traditional and alternative assets, liquid markets showing significant absolute and risk-adjusted net outperformance. Unified and consistent theory with further applications to option arbitrage and risk management, in particular the detection of time bombs in portfolios by employing an expected marginal attribution approach.